Well, this is interesting. The two most crowded trades are long tech, and we think the Magnificent Seven will be fine, but they're going to underperform into the second half of the year. But short China is the second most crowded trade for institutional investors. And we think the worse the headlines get, the more bullish it becomes, because the Chinese government has been acting at the margins to stimulate, cutting mortgage rates we saw, cutting short rates for banks, et cetera. But they haven't done the big bazooka. They haven't put money in consumers' pockets. And everyone, they're going to be forced to do that before the end of the year, and that's going to be a monster boon. The other thing, if you look at, the headlines have been bad, but if you look at China internet stocks, Alibaba, Pinduoduo, Tencent, their earnings have been off the charts. EBITDA was up in aggregate 30% year on year. Revenues were up about 7%. So I think once the Fed is winding down the tightening cycle, as we talked about earlier in the segment, you're going to see rates compressed, you're going to see the dollar weaken, you're going to see flows into emerging markets, and then you're going to get the China stimulus on top of that. It's a trade that no one wants to talk about right now, but I think as you look 12 months out, you're going to be extremely happy that you participated in emerging markets for the next 12, 18, 24 months.